Welcome to our eSignal weekly Forex and futures forecast. My name is Jay Norris. I teach trading at Trading University. As always, we also need to remind you that trading is a risky endeavor and not suitable for all investors. First market we're going to cover would be the Australian US dollar. Here's a weekly chart of the Aussie US dollar. Let's give you a little bit more information there. I think you'll see 85. I think outside shot even see 80 even, just above that 618% retracement of the market bottom in '08. We see some more downside here. However, if we scroll down now to a little bit shorter term, take a look at the daily chart, you can see some signs of life here. Friday, you had an uptick. You had a poor U.S. employment number. That turned the tide for the U.S. greenback, lent strength to the Aussie. From a shorter term perspective, more of a trader's perspective, we could probably anticipate some more upside to this rally in the Aussie. You have that nice big wide double bottom, basically it bottomed late summer, early fall, and then you had the second tranche, or the second bottom, I should say, in December of last year. So you have a pretty wide double bottom. That likely means you'll have a little bit of upside here, at the very least short covering, more of a trader or swing traders event. But we think overall, from an investor standpoint, that 85 is likely to be the next major stop here. As far as upside to any kind of short covering rally here, I don't think you can rule out 94, even 95 here for an upside target. We think at that point that'd be a pretty good area to enter shorts from. We'll stay on top of that for you also. Next market we're going to take a look at will be the dollar index. Here's the dollar index. From our perspective, you really have to pan all the way out to a monthly to get a good look at where you've been and where potentially you go. It's been a long, drawn-out bear market for the U.S. dollar. We see major support below where it bottomed earlier in 2013 at the beginning of the year. Let's go down to a weekly chart. You can see some detail. We feel there's a lot of support above 79 even. We love the index all the way down to 77. We think there's plenty of support down there. It would seem unlikely you'll test that. We think now is a pretty good time to take a look at this market. We think any kind of dip in here you want to be bought. We like the 80 level. We really like 80 all the way down to 79. Really, it's the old saying: if you like it at 80, you love it at 79. You'll be ecstatic at 77. This is a market that, from an investor standpoint, we think it's a very good time to be considering entering long-term trades. Also, from a trader standpoint, we feel it's an excellent market to be monitoring to buy dips. Next market would be the euro, which is which would be the mirror opposite of the greenback of the U.S. dollar. And we're pretty happy about that short covering rally we're seeing in the euro right now. This is a daily chart. You had that disappointing U.S. jobs number on Friday, and that put a pretty good bid in the euro. We're pretty excited about the euro because we'd like to see this formation be finished off here. Here, let me show you a 4-hour chart of the euro. And we like this big topping formation you're in now, though, but we don't see it as being complete. We would like to see a right shoulder here, for lack of a better term. Yeah, let's just call this a big head and shoulder top. Left shoulder, head, right shoulder. You put in that right shoulder. That may be interesting. Here's something else that's interesting in the euro when we take a look at the volume in this market. I want to show you this. The volume on this last leg up was pretty light. Here's your volume down here. You had pretty good volume on the way up, but this last leg up here, pretty light volume. Then look at how the volume increased on the downside. Granted, you had pretty good volume yesterday, but overall, you made a major shift here in December from the last rally up was on light volume. Now this first big leg down where you made a lower low here. Here's your lower low compared to that low. That was on heavier volume. So you're seeing heavier volume on the downside. So we'll monitor the volume here, but we're pretty excited. If we see a rally up towards 138 again, and it's on light volume, we see that as an excellent opportunity to set up long-term shorts here. When we pan out to the weekly chart, you can see that overall, this double top in 2013, it's just potentially another lower high along the way. Lower high, lower high, lower high, lower high. That spells a bear market also. So we think, again, there's a potential here for a nice longer term short being set up. So we're kind of licking our chops here about a potential short covering rally. If the market makers, or I should say the primary dealers who also have market making operations, if they end up, punching this market higher to go after those stops, potentially you have a lot of buy stops above 138, individuals or traders who are short already. If you stop those out, we think that you have a nice setup here, nice long-term setup to short from. And again, similar to the dollar, it looks great from both an investor standpoint, and a potential rally to sell would look great from a trader's perspective. Next market, dollar yen. Yeah, dollar yen, we see relatively limited upside. We think 108 is your upside. 108's been a long-term target of ours. Boy, you got more than 3/4 of the way there. Kind of tough to be excited about that now. So, dollar yen, it's a great trading vehicle for us, but right now we don't see it as having all that much potential unless you got a sell-off here. We would welcome a steep sell-off, even though we're bulls on that market. We would see a sell-off as an opportunity to position ourselves long for that run to 108. Hopefully, that poor unemployment number in the U.S. that we just got passed on January 10th, hopefully that leads to a steeper correction in that market, which we would see as, from an investor's and a trader's standpoint, as an opportunity to get long. If you're long dollar yen already, you just stay the course. You're an investor. You've got to take a long-term view of this guy, and we think 108 is still going to be in the cards. On the commodity side, corn looking very interesting. Look at the 3 C's today: corn, crude, and copper. We love corn at these levels. We think if there's a time to dollar cost average corn, it's the time to do it now. Corn, both a feed product for both us and livestock, and has the benefit of that energy component, i.e. ethanol. Let's take a long-term look at corn. The reason we love this $4 level is because if you go back into the 80s, 70s and 80s, $4 was the lid in corn. $4 was the top in corn. Now, there's a whole lot more people to feed now than there was then, right? The population continues to grow. Now, we think that science and the farmers themselves have done a great job as far as getting more yield per plant in the corn, but the bottom line is you're still only going to get about 2 ears of corn per plant. So the point being that we think productivity is made its run, and we don't think you're going to be able to squeeze much more yield out of corn such as you have in the last couple of decades. So we really see that the bottom line is they don't make any more land, as the old saying goes. So you're not going to have more acreage for corn. So how are you going to get more corn to feed more people? Well, that's going to be difficult to do. So we see this as a market where you'll continue to see demand, but supply is going to probably remain where it's been. So hard to squeeze more productivity out of there, hard to squeeze more yield out of the plant, hard to grow more corn, yet you have more mouths to feed. So we like corn long term from an investor standpoint. Let's pull back down to a weekly chart. We think that the way to go would be to consider dollar cost averaging this market, and this is not to say this market can't go to $3, right? So you want to start small. If you're a futures trader, you have the mini corn. We would prefer the ETF corn, CORN. This is probably a good time to consider maybe starting to buy a little bit of that in your investment account or your IRA. Start to nibble on that ETF CORN. Here it is. Because we think that historically corn is going to be pretty cheap. I'll go back to that futures chart and make that point that the old ceiling becomes the floor, and we think that'll be the case. Corn, people have to eat, and that's our energy play too. I'd rather be long corn than long crude at these prices. So let's see if corn starts to bottom out at $4. And this is one we've talked about in the past, and we'll continue to cover that for you. So we think the time is right to start to nibble on corn at these levels. Next market, crude oil. Anytime I see a double bottom on a futures chart, I realize there's the potential for a hiccup, a uptick. Now, I'm not saying a reversal. On the other hand, you get a short covering run in a commodity can do some serious damage to your average speculator's account, right? So from an investor standpoint, we think you continue to sell rallies in the crude oil, but from a trader standpoint, you have to be leery of a potential short covering rally here. It all comes down to that unemployment report. It keeps coming back to that. If you get some long liquidation in the U.S. dollar, some short covering in the euro, we think that sets you up for a pretty good trade, adding to investments also. In commodities, though, they're a little bit different. They're more volatile. You have all that leverage in there, and that could be dangerous. So we see overall an opportunity to continue to sell rallies in the crude oil, but we think you need to be pretty careful about that in the commodities, especially when you still have that big wide double bottom on the chart there. Similar to the Aussie, you have a wide double bottom. That just means it could set you up for a bigger short covering rally. We still think that rally would be an opportunity to sell. So crude oil, we still like selling rallies. If you're short it, we think you got to tighten those stops down. Last commodity, last market we're going to cover would be the copper market. When it comes to copper, there's a limited number you can pull out of the earth, and it's not like people are going gangbusters to discover more copper as they are crude oil. On the other hand, where's the demand going to come from after the huge demand you saw when China built all those cities? So this is a market that we don't see it probably going anywhere too fast longer term. You'd probably want to sell rallies because where's demand going to come from? And we think there's probably room down below, given you have a decent amount of supply out there, but on the other hand, there's really no great hurry to get it out of the ground, which means the market's probably not going to collapse, but at the same time, you're looking at this sideways range you're looking at right now. Probably makes pretty good sense to us. But we would still favor, from a long-term perspective, selling rallies in the copper. Certainly if you have exposure in the copper markets as a hedger, you want to continue to sell rallies in that market. So from our perspective, the big one to watch is still going to be the greenback, is still going to be the U.S. dollar. That's one to watch. You have good support here. When you pan out and you take a look at the long-term view, boy, there's a lot of room on the upside. And we think this will be influential for all the markets, all the currencies, all the commodities too, certainly the value of the dollar. Again, my name is Jay Norris. Hey, thanks for sitting in, and come and see us again next week for the weekly update. Thank you.